Good morning, everyone. Welcome to this update for global stocks and commodities for the 19th of May. There was a bit of a panic sell-off in the US on Monday night in recognition of China's retaliation on the trade war, but there was no follow-through selling. It dipped for a day and then basically spent the rest of the week working its way back up again. And that was pretty much what the facts would really dictate, because there really isn't a basis for anything more than just some mild sell-offs, perhaps 3 to 5% type of variety. So everything is reasonably in order in America. There's a lot of people that are nervous, and that'll continue to cause volatility. But the prospect of something larger in terms of pullback than what we've seen, I don't think is very strong. So let's jump in. As I said, there was really no follow through in the panic selling that we saw the week before and that we saw on Monday, and I'll cover a point shortly, just looking back over the last 3 years about how many small pullbacks we've had and how many more significant corrections that we've had, and it makes interesting assessment. There'll be the normal stock and commodity trend update, but not a lot has changed in the week, so this won't be a long video. And Portfolio Analyst last week, I covered the medium-term outlook as I see it, and also there were lots and lots of excellent questions for analysis as well. So the American stocks, the S&P started with a sell-off, but ended up only losing 22 points for the week, so that was a pretty good recovery. And since 2016, there has been 15 events, if you like. 4 of them have been major declines of between 10 and 20%, and 11 of them have been minor declines of less than 10%, with most of them being less than 5%. So that's the history since 2016. 15 events, but only 4 of them managed to go beyond 10%. And what I can say is that each of those 4 events were associated with one form of monetary tightening or another. The circumstances were a little bit different from 2016 to the end of 2018, but they were all associated with the prospect or the actual realisation of some monetary tightening. Now that, as you know, is now off the table, and it's going to be extremely difficult and extremely unlikely for central banks to revisit that anytime soon. And so therefore, it's really on that reason alone that I feel reasonably confident we're not going to see any more significant downsides. I just don't see the trade dispute as being sufficient to cause a greater than 10% correction. So therefore, I can't see that this current pullback is going to be anything other than a minor one. And the trade war, when you really look at it now that we've had a year or so to contemplate it and how it's unfolded, is really more about ideology, I think, than about trade. It's about China wanting more power on the world scene, and America not wanting to give it up, and therefore I don't see that there's going to be any resolution at a big picture level, because those two opposing forces are neither are going to give up on their aspirations. So I think this trade war in varying forms is going to go on for years, and it's going to create periodic volatility. Now, my view is that volatility is a really good thing. But it scares the heck out of a lot of people. I think in the short to medium term, as in the next 3 to 6 months, I think the most likely outcome, and this is not a prediction, it's just based on probabilities, the most likely outcome is a trading range. I can't see what would drive the market more to the downside, and I can't see what's going to drive the market to some sort of significant breakout either. So really, by process of elimination, I think the trading range is by far the most likely medium-term outcome. The US dollar in fact, it was up slightly last week. I didn't amend that slide from last week. It actually rose, and the 10-year Treasury yield slipped a little bit further down to 2.39. And you remember it was only a year ago that people were above 3 and people were talking about 4% as being inevitable. And ever since that thought took hold, the 10-year Treasury yield has done nothing but go backwards. Let's jump in and look at the S&P. So you can see we did have a dip initially under the 50-day moving average, which is the blue line. We were unable to get down to the 200, and we got quite a nice bounce. So that was the big sell-off on Monday, which is that gap and a red candle there, and then the rest of the week the index worked its way back higher. And I think that we're just going to stay in a range that looks something like this. Perhaps we've seen the lows. We might go a bit lower. We might get down just below the 200-day. But I think it's something of this order is what we're likely to see for the foreseeable future. And it will possibly be quite volatile as the varying opinions go backwards and forwards. Okay, let's look at the US dollar quickly. So we had quite a strong finish. So it was pretty much all up during the week for the US dollar. And of course, two things really smashed the Australian dollar, which ended up well down. So the Australian dollar has now had a very significant breakdown from that trading range that it was in. So I'll just put some lines around that so you can see it more clearly. So we were clearly in a downsloping wedge. We've broken out of the bottom of that wedge, and the Australian dollar looks really, really vulnerable now. So two things: partly the US dollar going up, that caused the Australian dollar to go down, but also concerns over China, the health of the Chinese economy, and that would always affect the Australian economy and hence our dollar. But also when the jobs data came out last week as well, that really firmed up people's opinion that the RBA is going to have to cut rates, and that really put the skids under the Australian dollar. So where do we go to? Well, we've got support down here at 67, and then beyond that, you've really got to go back quite a long way, which is basically the GFC lows down around 50 cents. So we've got some important support coming up, as you could see, around 66.5, 67, and if that breaks, then there's really no support until you get down to 50 cents, and that would be particularly nasty for the Australian economy. All right, so just to summarise on Aussie stocks, so we finished up down at 68.67, and people are now talking about 2 rate cuts and possibly even having to go below 1%. So great for mortgages, not so great for overseas travel. Our index rose by 55 points on the week. And I think there's a pretty good chance we could see a bit of a sugar hit from the election result in the next few days. And whilst it's going to be either a minority government or a slim majority, I think it's the clear mandate that that Morrison has got, which means that he can perhaps get on with things more than any other outcome would have provided. And that's not a statement about which party was better to win. I just think that he now has a very clear mandate to get on with it, and that should be good for the economy, and it should be good for the share market. So we will quite possibly see a further election sugar hit in the next few days. There's almost nothing in the top 100 that I would own unless its business operates independent of the local economy. So it's got a global business. Most of its revenues come from overseas, or it's an exporter that sells product in US dollars. So there's very little that I would own, and I think one of the concerns that is out there is that many of the traditional dividend stocks are going to be experiencing dividend pressure, and if those stocks are under dividend pressure, then that's also going to feed into some larger capital losses. So it's a double-edged negative sword, really, that the people that were looking for for income from those dividends are not going to get that, and then the ensuing sell-off would just compound that. So it's not a particularly pretty outlook for the Australian share market in general. Sorry, let me just get to the right screen. So let's just have a quick look at the ASX 200. So you can see we did have a sell-off on Tuesday, which was in response to the sell-off on Monday night in the States. But then after that, it went pretty much upwards. But it's really interesting to look at the sector split. So there was a lot of confidence around the major miners and also the energy sector as well. If you look at Woodside, was very positive. So Woodside had a good week. But if you look at the banking sector, it went the other way. And there's a lot of things that are basically headwinds now for the Australian banks. Turning now to precious metals, gold under the pressure from the US dollar fell another $9 down to $12.78. But the Australian dollar gold price shot up to $18.60. So it's no wonder our gold miners are doing very well. And GDX actually rose. So the gold price went down, but GDX actually steadied. Went down a little bit during the early part of the week and then had quite a good reversal on Friday night against the trend. So that's indicating that, people aren't expecting the gold price to go too much further, and they basically stepped in and started buying gold stocks. The local mid-tier stocks, so the Northern Stars, Evolution Mining, etc., they're all fully valued based on normal metrics, as I would see it. But that, of course, doesn't stop prices rising. And we do have clearly a substantial mergers and acquisitions cycle going on around the world in the sector. And I think it's inevitable that that one of the top 4 or 5 Australian mid-tier miners gets a bid lobbed at it from one of the majors overseas. So let me just quickly check in on the gold price. So there's the daily. So you can see some heavy selling on Thursday and Friday in response to the US dollar. It still is holding into this upward sloping channel, as you can see, which had its lows in August of 2018. So it really needs to hold on to that level. Otherwise, we're going to be perhaps heading down to the 200-day moving average, which is around 1256. If we look at this on a weekly chart, you can see that it's really just all part of a quite large wedge pattern, which has an upward sloping bias to it. So that's the gold price. And if we look at GDX, that's on a weekly. Let's just zoom in and have a look at it on a daily. So you can see we were pretty much flat for the week, but quite a good turnaround on Friday when the gold price went down quite sharply. Moving on to other commodities now. Copper was down, again, currency effect, but crude oil actually went up, 62.76. So inventories went up, which would have been a bit of a negative drag. Currency went up, which was a negative drag, but the price of crude went up anyway. So that was quite an interesting move. There's the spot copper price and the crude oil price bouncing back last week. So to wrap it up, it really is, as I said last week, it's just a time to shut out all the noise. You've got to be very focused on your game plan. A volatile trading range is also an opportunity. A lot of people get nervous and a bit scared about volatility, but it's an opportunity. You just got to know how to use it. You might need to amend your trading style, but this is good. You got to be a bit more patient. You got to be more clear about what you're doing. You got to have high conviction about what you're doing, but you can get prices and rebounds that aren't normally available in a non-volatile market. So embrace it. Portfolio analyst this week, I'm really going to be focusing heavily on how to use volatility to advantage. It's very much about trading tactics and how to structure your trade. So that's going to be the focus in Portfolio Analyst from here on in. If you haven't tried Portfolio Analyst, then there is the $1 2-week trial, which is available, and I think you'll find a great deal of education in that service. There's my contact details for any non-members, and I'm sure we'll have another fascinating week coming up. That's it for this week. Cheers.